In 2020, SPAC raised more capital than IPOs for the first time in history. By 2022, most had collapsed. What happened? A SPAC is technically a shell company. It's a vehicle with no business, no products, no revenue, just cash and a mandate. Find a private company, merge with it, and take it public in months instead of years. Wall Street called it innovation. It was, more precisely, a regulatory workaround. The traditional IPO process takes 18 months, involves exhaustive SEC scrutiny, and exposes executives to liability. A SPAC merger compresses that timeline and shields deal makers from certain disclosures. So who engineered this? Blank check companies existed before 2020, but they were niche. Then, around 2019 and 2020, venture capital and hedge funds realized they could raise billions by promising to find the next unicorn. Chamath Palihapitiya, Bill Ackman, and other billionaires became SPAC sponsors. They'd raise a fund, keep a percentage of the upside for free, and hunt for targets. The incentive structure was clear. Merge fast, merge big, collect the fee. Regulatory scrutiny, that came later. By 2021, SPAC had become a mania. Celebrity athletes merged with SPAC. Celebrities became sponsors. Every failed tech founder could resurrect their brand through a SPAC merger and claim a second act. The SEC watched this spiral, then acted. In March 2021, the agency began tightening disclosure rules around SPAC projections and sponsor compensation. That was the crack in the foundation. Here's what the predictors saw. SPAC had no earnings to justify valuations. They relied on narrative, the story of what the merged company would become. The moment interest rates rose in 2022, growth narratives died. Inflation fears, Fed tightening, the collapse of crypto and tech valuations, all of these squeezed the air out of SPAC economics. Sponsors had promised returns. Returns vanished. Lawsuits followed. The regulatory challenge then wasn't that SPAC were new. It was that they exploited gaps between private and public market rules. A private company faces limited disclosure requirements. A public one faces strict ones. SPAC let sponsors blur that line. They promised speed and access, but delivered opaque valuations and misaligned incentives. The SEC's response, tighter disclosures, sponsor skin in the game rules, attempted to close the loophole. But here's the feedback loop nobody discusses. Every time regulators tighten one loophole, capital finds another. SPAC didn't die because regulation killed them. They died because the economics broke. Once interest rates rose and growth stories collapsed, the merger model itself became toxic. Sponsors couldn't raise new funds. Targets couldn't justify the valuations. The system corrected itself through market forces, not just enforcement. SPAC rose because they solved a problem for the ultra-wealthy: how to take companies public without the friction of traditional gatekeepers. They collapsed because that friction exists for a reason. It separates signal from hype. The regulatory challenge remains. How do you allow innovation in capital formation without sacrificing investor protections? That tension hasn't been resolved. It's just shifted to the next vehicle. This video is for educational and informational purposes only and is not financial advice. Always do your own research. If you want to understand how the wealthy bend financial systems before regulators catch up, subscribe. We break down the next loophole before it closes. This video is for educational and informational purposes only and is not financial advice. Always do your own research.